Thank you so much for signing up and registering today. I think these webinars that we at the state office have done have been a big hit. And this one today had the most registrations we've ever had for a webinar at 357. So I know there's a lot of interest in today's presentation, which will be done by Jacob Kuebler. He is with Bluestem Financial. He is a senior financial partner, or excuse me, senior financial advisor and managing partner. And I believe Bluestem is based out of Savoy, Illinois, and Jacob will be talking about retirement taxes and recent tax law changes and how it can impact state retirees, of which many of our members are. So with that, Jacob, I will hand it off to you and you can get started here.
All right. Thank you, Thomas. I first want to just do a quick thank you for the invite today, both to Thomas as well as Betty Zedek, who did the introduction of myself to the SUAA organization. I'm super excited to be here. I'm also really thrilled that so many people have showed up. I know taxes isn't always the most interesting of topics, so I wasn't quite sure what the response would be, but I think it's going to be really timely. So I hope you find our conversation today helpful in thinking about your own situation and adapting to some of the recent law changes, both on the tax front as well as Social Security changes. Quick background about myself. So Thomas did a great introduction. So we're kind of located in the Champaign-Urbana area. Our firm was started by a university employee, Karen Folk, who was a faculty member in the Consumption Economics program, which was the predecessor to what nowadays would be financial planning at the University of Illinois. So through her work in her academic days, a lot of our clients are either currently working in or retired from the SERS program. So another reason for me to be excited to be here with you guys today. And then in addition to that, we also, I teach at the U of I as well. So love the opportunity to talk with current and retired people from SERS. I'm getting a note that maybe some people can't hear me. Thomas, I'm just curious, can you hear me? Okay, excellent. Sounds like audio is good. All right, so just quick disclaimer as we get into this, just know that taxes can be very complicated. I am going to try to use examples to illustrate various concepts that we're talking about today, but keep in mind that individual situations can vary, and therefore the impacts of the different strategies that we're going to be going over could affect your own tax situation differently. So if you are working with a tax preparer and sort of want to see how some of these things will impact your individual tax situation, it's always a good idea to kind of model out because the way that the tax code works, it can be quite complex. The other thing that I'll mention is we do talk a lot about SERS, both with our clients and in various different presentation formats. SERS has just asked us to remind people that we are not affiliated with SERS. While we do work with many clients in the SERS system and believe that we have a lot of knowledge around that, we are not, none of the information that we'll talk about today has been endorsed by SERS specifically. Okay, so with that, today's focus is going to be around sort of navigating recent tax and other law changes for retirees specifically. So just to kind of give you an idea of how we're going to go through things today, we're going to talk about this new tax bill that passed this year, the One Big Beautiful Bill Act. So we'll be kind of going through an overview of what's new, what's staying the same. And as we go through that, we'll talk about various strategies that people who are either currently retired or even some pre-retirees may want to be thinking about with some opportunities to take advantage of existing and new tax law. In addition to that, there was some major changes with the Social Security system that also is a major impact to SERS members or SERS retirees. So we're going to go through that as well, and I'll give you some tips there on things to be thinking about, how to make sure you benefit from those changes, as well as some impacts on the tax side of that. So as Thomas said, we'll for sure leave some time at the end for Q&A. Again, I'll try to run through some examples as we're going through to illustrate points, but I'd also love to hear from you. So make sure to put those questions in the chat. So just to kind of kick things off here, I'd love to maybe just do a brief overview of recent tax law. I'm imagining that probably most of you don't spend every waking moment thinking about the, tax landscape of the U.S. And therefore, a lot of people tend to think that our tax code is static. But the reality is taxes are really changing all the time. So specifically today, we're going to be focused a lot on the One Big Beautiful Bill Act, which is the newest tax legislation that passed back in July. But I just wanted to do a quick overview of how things have changed over the last 6 or 7 years. Starting with 2017 was really the last major tax reform. That was the Tax Cuts and Jobs Act of 2017, also called TCJA. So the reality is our newest tax bill, the one here back in the summer, was really mostly just an extension of a lot of changes that happened back in 2017. So some of the headline changes that happened back then were tax rates were slightly reduced. They added a higher standard deduction, which was somewhat offset by the elimination of personal exemptions. So those were just an additional deduction that you would have gotten on your tax return per person in your household. The big thing that changed for a lot of people, especially those living in Illinois, was state and local property taxes were capped as an itemized deduction. So that meant even more people were now going to take the standard deduction because of those higher standard deduction plus that cap on the tax deduction. We'll actually go through some examples of that because there's been some more changes. And then the final major change of 2017 was there was an addition of this new deduction for business owners called the Qualified Business Income Deduction. That one was actually extended and somewhat slightly enhanced as part of the new legislation. That really only affects people who own small businesses. So that could be anything from doing consulting on the side to owning like an LLC or an S corporation. I'm not going to really get too much into that today, but that might be something to pay attention to if you do have any ongoing income from, consulting, authorship, royalty income, that sort of thing. So 2017, that was really the last major legislation. Notably, tax law typically, historically, has been revised every like 20 to 30 years, kind of the once in a generation tax overhaul. 2017 was certainly a big change. One thing that did not happen was simplification, which is kind of unfortunate. So as we go through the examples today, we'll talk about sort of the complexity of navigating current rules, just given that it seems that at this point, we just keep adding new rules rather than going back and adjusting former rules to simplify. Since 2017, there have been some other major changes, including the Secure Act, which actually came in two parts. One was in 2019 and then another in 2020. That one actually does have a major impact for retirees, which is for those of you who contributed to supplemental retirement accounts, whether it was the 403B or deferred compensation to the state of Illinois, or even set up IRAs or that sort of thing as supplemental savings in addition to your service pension. There were some changes to what's called the required minimum distribution. So under the old rules, when you turned age 70 and a half, which again, in Congress's wisdom, for some reason they chose age 70 and a half instead of age 70, they said you must start taking money out of those retirement accounts. The Secure Act, one of the major changes there was they actually started to increase that age. The age that is generally applicable to a lot of people today is age 72, but it is birthday specific. So for people who are younger, so for example, people born after 1959, I believe, the age will start increasing to 73 and then eventually to up to age 75. So that might be something to pay attention to if you're thinking about when do I have to start taking money out of my IRAs. It is now age 72, and for people who are younger, it may climb even further depending on your date of birth. So that's a big planning opportunity there. The other thing that happened was the rules around your beneficiaries of your retirement accounts have changed. So under old rules, if you didn't spend all of your retirement assets and left it to kids or other family members, they would be able to stretch out and take distributions over their lifetime and pay the tax over the next 10, 20, 30 years. The big change in 2019 was they actually eliminated what's called the stretch IRA for many people. So what that means is if you die and leave money to your spouse, they continue to get the tax advantages of that retirement account. But if you leave it to kids or other relatives, they may actually need to take those retirement distributions much faster, which can create higher taxes for kids and grandkids. So again, I have an example at the end that will kind of talk a little bit about that. So in addition to the Secure Act, there were a bunch of other bills. I'm not going to get into those specifically, but a lot of sort of COVID relief. The main impact to be aware of there is various credits have sort of come and gone as Congress and legislatures have tried to, incentivize various behaviors or just give more money to certain classes of people. So for example, people with younger kids, there was increased child tax credits and so forth. So again, to kind of summarize the new tax bill of the summer of 2025, the One Big Beautiful Bill Act, really for the most part is mostly just extending the provisions that were started in 2017. And the reason for that was in 2017, in order to pass that initial tax legislation, not all Congress people were on board. There was some disagreement about what provisions should and should not be in there. And so in order to avoid the filibuster, they needed to make sure that the bill was balanced in the sense of the idea that any tax cuts were offset by new revenues. So they used this process called budget reconciliation, and they put a sunset provision on the 2017 bill that essentially said most of the new tax provisions in 2017 would sunset and go away at the end of 2025. So that was sort of what we were expecting is this year, either Congress would act and pass a new bill, or if nothing happened, we would see all of the tax changes in 2017 go away and revert back to the law of the land pre-2017. So that's really the big change into the One Big Beautiful Bill Act. There were a few new provisions that were thrown in as additional tax deductions or tax credits. And again, we'll go through a few of those examples today. The one thing that is going away under the new bill is most of the energy tax credits that have been available for many years and have been changed over time. Those are sort of the most time-sensitive things. There's actually one that already expired specific to electric vehicle tax credits. So that one's actually done. There's no more availability there. But the things that are still available are, there is a 30% federal tax credit for people who install solar, wind, or geothermal systems at their primary residence. It's probably a little bit too late to get those things on the calendar or on the schedule now if you were interested in doing those. But if it was something that you were doing, if you already have a contract with an installer, you want to make sure that the systems are in place and activated before December 31st. This is something we've seen a lot of with our clients, and solar panels have been very popular in our area just because of both the federal credits. There's some state incentives through what's called solar energy credits. So between those two things, the cost of the system is brought down by well under half of kind of the total cost of the system. So that one unfortunately does go away. The other thing that we've seen a lot of people utilizing are the home energy efficiency credits. So those are credits available for people doing energy efficient updates or upgrades to their home. So like windows, doors, insulation, as well as just replacing older water heaters or HVAC, heating and air conditioning systems. So all of that does go away at the end of the year. So if those are things that you are already planning on doing soon, you may want to try to accelerate those and get it done before the end of the year. Generally, those credits are 30%, but with each class of items, the credit can vary based on, the cap on those can vary based on what particular item you're installing. So just to circle back, kind of addressing the headlines of the new tax bill, what exactly changed? Again, most of what we're seeing is just an extension of the tax rates that were already in place. So if you hear that there was additional tax cuts under the new bill, that is true to some extent, but really a lot of the cuts were cuts that happened previously. So what I'm showing you on the screen right now is sort of a hypothetical of what would have happened if the One Big Beautiful Bill Act had not passed and we had gone back to the older tax rates. So you can see here, they kind of have a side by side of these are 2024 rates. Because again, I just want to illustrate kind of an example of what might have happened. But you can see this would be for someone that's married filing joint. This would be for somebody that's single. So somebody in 2024 who was married with less than $20,000 of income would pay a tax rate of 10%. That's actually the same as what it would have been under the old laws. So when people talk about tax cuts, it's really at the rates higher than that. So for example, what was previously the 15% tax bracket was reduced down to 12%, the 25 down to 22%, and so on. Now, one thing that I want to quickly point out is one point of confusion that we often see with talking to clients about their particular tax situation is just really understanding how tax brackets work. So the thing about tax brackets are the tax brackets are marginal. And what I mean by that is let's just hypothetically say that we're looking at a married filing joint couple with $80,000 of income. Now, the thing to keep in mind is your gross income isn't necessarily all taxable. What I mean by that is the way your tax return works is you add up all your sources of income, but then you get to deduct various things, including the standard deduction. So most people don't pay tax on every dollar of income earned. The other thing is you don't pay your top tax rate on every dollar. So again, for that married filing joint couple with $80,000 of income, they might have a standard deduction of $25,000. So they're actually only going to pay tax on maybe around $60,000 of income. So that would put them in that 12% tax bracket. The other thing that people worry about is, well, what happens if I push up and get a percent bracket? Does that mean I now pay 22% on every dollar of income? And no, the answer is no. The way that our tax code works is your rates are marginal. And what that means is even that couple earning $80,000, they still pay 10% on the first $23,000 of income. It's only the income above that 10% rate that gets taxed at 12%. So anytime you're sort of on that edge of moving into a higher tax bracket, you don't need to worry if you go over by $1. It just means that last dollar of income gets taxed at the next higher rate. So just to kind of summarize here, the new bill reduced those sort of marginal rates. So again, the 15% bracket went down to 12, the 25 down to 22, the 28 down to 24. It's a little bit more complicated than just a top line tax rate because, again, they changed the deductions as well as the tax rates. So if you end up with less deductions but a lower rate, you might actually be break even. If you end up with more deductions and a lower rate, of course, you might be ahead. So speaking of deductions, there were more changes in the standard deduction this year. So basically in 2017, they substantially increased the standard deductions. So that was extended under the new bill. So over here on the right hand, I have a chart that kind of illustrates what those new standard deductions are under the One Big Beautiful Bill. So for someone who's single, the current standard deduction is $15,750. For someone who is married filing joint, the standard deduction is $31,500. In addition to that, there are additional deductions available if additional standard deduction that is available based on age. So for those who are 65 or plus, there's an additional deduction available depending on your filing status. So that's what this lighter blue here is. So for a single person over the age of 65, you get an extra $2,000 standard deduction. If you are married, the additional deduction is slightly less, but you get that additional deduction per person who's over age 65. So if one spouse is 65 or older, it's $1,600. If both spouses are 65 and older, it's $3,200. So again, all of this so far is just mostly extending what was already in place and inflation adjusting it. What's new is, in addition to the standard deduction, there was this new enhanced deduction called the enhanced senior deduction. This was touted as the no tax on Social Security provision. That's not actually true that you don't pay tax on Social Security. What happened was they added a new deduction for people who are age 65 and over to take an additional deduction above the standard deduction. And this deduction applies whether or not you take standard deduction or itemized deduction. And it basically adds $6,000 of additional deduction for each person who is over the age of 65. Now, with a lot of tax law, there are always if, ands, or buts. So let me point out the two exceptions here. So the first one is this deduction does start right away. So it will apply to your 2025 tax return, but it is not permanent. This particular provision is only good through 2028. So what that means is if Congress doesn't act again between now and 2028, this additional deduction will go away. The other thing to know is that this new enhanced deduction, so this additional deduction for seniors, does phase out, or it's means tested, meaning that for people who are a higher income, the reduction or this additional deduction starts to go away as your income climbs. And those limits are, for someone who's filing single, your additional deduction starts to go away at $75,000 of income. And if you're married filing joint, that's at $150,000 of income. And that phase out is based on what's called adjusted gross income. So that's going to be all of your income before deductions. That's going to determine whether or not you're eligible for this new enhanced tax deduction. All right, well, I apologize that people could not previously see this slide, but I guess just to quickly recap, estate exemption, 15 million from the federal level per person up to 30, and then the annual gift exclusion, $19,000. The main thing to probably be aware of is Illinois and federal limits are not coupled together, meaning that there are separate limits for federal and Illinois, and the Illinois exemption level is currently 4 million. Still pretty high, but as my image on the screen alludes to, that's not a very big number for many farm families or people with, businesses of, with value there, like machinery and so on. So that is something that can be a consideration. Even a somewhat small farm operation, $4 million does not go super far. And the other thing to be aware of is Illinois does not have a portability provision, which means if you die and leave everything to your spouse and then your spouse dies, that $4 million only applies once. So it can require some advanced planning for people with some amount of investment assets plus a farm or other business. Okay, so on to the things that we're kind of seeing impacting people more broadly is the big one I mentioned before, the state and local tax deduction. So back in 2017, they capped the amount of state and local taxes that someone would be able to deduct as an itemized deduction. That was to great consternation for many people in the state of Illinois because we have both a state income tax and because real estate taxes in Illinois tend to be higher than many other states. So that was an item that negatively impacted many taxpayers in Illinois. So starting in this year with the new tax bill, that limit has been increased to $40,000. Again, like many of the new changes that were put into place, this is a means tested provision. And what that means is that does not apply to people with higher income. So that one in particular phases out at $500,000 of income. So that does mean that most people would potentially benefit from that higher deduction. They did also add an inflation adjustment, meaning that limit will go up by 1% per year. The main thing to know is this new deduction is, again, it's not permanent. So if Congress doesn't make any additional changes, this particular new enhanced deduction will go away starting in 2030. So I'm not really in the business of predicting what Congress is going to do. There's always the possibility that Congress may come back and decide to extend that one again. So I wanted to give an example of somebody to just kind of illustrate, like, what would this look like? Why does this affect so many people in Illinois? So I picked imagine a taxpayer who's married, they're 60 years old. So maybe they're kind of in that last couple of years of working. So they're paying about $12,000 of Illinois income tax. Plus they own a house and they pay real estate taxes of $10,000 per year. Plus they have $10,000 of mortgage interest. And then they make charitable gifts of $10,000. So again, this is all hypothetical, but I just wanted to show under the old rules, so before the One Big Beautiful Bill, when they added up their deductions, they would have only benefited from $10,000 of tax deduction, despite the fact that they paid $22,000 of real estate tax and income tax combined. Plus their interest and charitable gifts total up to $30,000. And their standard deduction would have been $31,500. So that particular couple would have taken the standard deduction despite the fact that they pay quite a bit of income and real estate taxes. So in this particular example, the new enhanced state and local income tax deduction is going to be a major benefit for them. So now when they itemize, they'll get full credit of the Illinois and real estate taxes together. So that's the $22,000 referenced here, plus their interest and charitable gifts. So now their total itemized deductions are $42,000. So that means that above the standard deduction, they're going to get an additional $10,000, $10,500 of additional deductions. And assuming that their marginal tax rate is 24%, that means that they're going to save $2,500 on their income tax bill this year. So again, that's one area that we're seeing a lot of impact for people here in Illinois with those higher state and local property taxes. This also is opening up another opportunity, which is to do a strategy that we call bunching. So the idea here is that you are able to somewhat control when certain items that may be tax deductible could be paid. So imagine we're going to say all the same facts as that prior example. So same person, same amount of state and local property taxes, same amount of charitable gifts. So going back to that prior example, under the new rules, that person's total standard deduction itemized deductions were $42,000. So assuming that they just continue to do things the same way, in 2025, their standard deduction or their itemized deductions are $42,000. 2026, their itemized deductions are $42,000. That means over 2 years, their itemized deductions tally up to $84,000. One thing that we've been seeing with a lot of our clients is if you're already itemizing, you may want to consider the timing of certain deductions. So for example, many counties will allow you to prepay real estate taxes. And what I mean by that is in Illinois, we generally pay our property taxes in arrears. So the property tax bill that you paid in 2025 was for assessments done in 2024. So you could potentially go to your county assessor's office and prepay your 2026 bill by December 31st. And by doing that, instead of deducting $22,000 of taxes, you now deduct $34,000 of taxes this year. And then in addition to that, if you're charitably inclined and doing regular charitable giving, you could also consider prepaying your charitable gifts for the next year. Instead of doing even gifts every year, you do kind of an every other year strategy. So again, in this example, instead of doing $10,000 per year, you do $20,000 once and you skip it the next year. The reason why this is impactful is now your itemized deductions bump up to $64,000. And in addition to that, your deductions for the next year actually drop down to $20,000. But you always get the higher of your standard deduction or your itemized deduction. So for this particular case, you get $64,000 of deductions in 2025, and then you get the higher of the standard deduction in 2026, which is $31,500. So over those 2 years, you end up with $95,000 of deductions. So that means over that 2-year time frame, you're deducting an extra $11,000. And again, assuming a 24% tax rate, that's a $2,700 savings. So of course, you have to have the cash to do it, but that's a pretty good rate of return if you can afford to do so. So that's something that we've been seeing a lot of this year. And if you're in that area where you're close to itemizing or maybe already itemizing, certainly with this new enhanced state and local tax deduction, bunching might be something that you'd want to take a look at. If you're not going to be itemizing deductions, which again, many people will not be, a new item that's coming into play starting this next year, so starting in 2026, is there's going to be a new addition of an above the line charitable deduction. So above the line basically just means you get a benefit for some amount of charitable giving, even if you don't take itemized deductions. Again, that one starts in 2026, so it does not apply for this particular tax year. This one only counts for cash gifts. So this one would not apply to if you're giving away appreciated stock or giving old household possessions or things like that to like Goodwill or Salvation Army. This would be cash only. So cash, check, credit card, that sort of type of gift. And the new limits on that are $1,000 for someone filing single and $2,000 for someone who's filing joint. One thing for our retired clients that we have been considering is because of the higher standard deduction is we've been seeing a lot more people look for different ways to do their charitable giving because they're no longer getting that deduction as an itemized deduction. And the big one is that this opportunity that's called a qualified charitable distribution. So what this is for those of you, again, who did supplemental savings into a retirement account while you were working, may now have money in those retirement accounts. And if you have to do minimum distributions, you can actually choose, instead of taking the money yourself and paying tax on it, you can actually direct your IRA provider to send that money directly to a charitable organization. And this is called a qualified charitable distribution. Now, one thing to know about this is this can only be done from IRAs. So if you have money still left at your university 403B plan, you would need to roll that into an IRA in order to do this qualified charitable distribution. Unfortunately, that means you wouldn't be able to start the strategy until the next year because you may have to go ahead and take that minimum distribution this year. One thing to know about this as well is this no longer is tied to those minimum distribution age. So you have to be age 70 and a half or older, but the new minimum distribution age is age 72. So we do have a few clients who start doing this strategy even before they must take distributions from that IRA. And you can give up to $108,000, and that's per taxpayer. So if you're married, you could actually double that. Again, probably not a lot of people that are going to be giving $100,000 or $200,000 per year away, but we've seen a couple situations of people who are very charitably inclined and thinking, my kids are financially secure. I ended up saving more than I needed for retirement, so I want to fund a scholarship or some kind of endowment. And I'm going to do a $50,000 or $100,000 one-time gift. This could certainly be a great opportunity. So that's something that we're starting to see more of. So just to kind of illustrate the power of this particular strategy, I have another example here. So this time we're looking at a 75-year-old couple because, again, you can't start this strategy until you're age 70 and a half or older. And we're going to say that this particular couple has a current income of $215,000. So that is high. I picked that number specifically because I wanted to illustrate a couple different tax points that will become clear here in a moment. But their total income, so this might be a combination of their SERS, their Social Security benefits, investment income, and so on. They live in a slightly smaller house than our previous example, so they've got $7,500 of real estate taxes. Most of their income is retirement based, so they don't pay Illinois tax on that. So we'll say they're paying $2,000 of Illinois income taxes. Their mortgage is paid off, and they want to do $10,000 of charitable giving. So in this particular case, their if they were to itemize, they would only have 19,500 itemized deductions versus the standard deduction of 34,700. So what that means is they would not actually get any tax benefit for those charitable gifts that they're considering. So if instead this couple were to direct some of their IRA, their minimum distribution from their IRA, and give it to charity instead of taking it as cash themselves, on the right and the white, we show what happens to their tax situation. So previously their adjusted gross income was 215, but if they chose not to take that minimum distribution, sent the $10,000 of charitable gifts directly to the charity from their IRA, their taxable income goes down to $205,000. So that means that they're saving their 22% tax rate on the full amount of that $10,000 gift. So right off the top, they're getting a $2,200 federal income tax savings from this qualified charitable distribution. In addition to that, we just talked about a few minutes ago how there's this new enhanced senior deduction that actually phases out when your income exceeds $150,000. So because of the reduction in income from this qualified charitable distribution, they're actually going to get another $1,200 in deductions due to that enhanced senior deduction. So that's $200 of savings. And then even on top of that, there's another thing that a lot of our retirees get hit by, which makes them very unhappy, which is that your Medicare premiums are determined based on your income. So I actually have another slide for this. So what we're seeing on the right-hand side is that these are the income thresholds based on which your Medicare rates are determined. So this is for a married couple. There's a separate table if you're filing single that you can look these rates up on the Social Security or Medicare website. But what this shows us here is for a married person whose income is $212,000 or less, their Medicare premiums are $185 a month. That applies to Illinois retirees for the most part. So for most retirees who paid into the Medicare system while working and are part of the TRAIL total retiree insurance program, you do have to pay your own Medicare Part B premium, and that's currently $185 a month. So that prior couple, if they had not done that qualified charitable distribution, their income would have been $215,000. So that means they would have been bumped up into this next bracket. And that means that their Medicare Part B premium would go up by $74 a month plus Part D of $13 a month. So in other words, that couple would have ended up paying an additional $2,000 in Medicare premiums based on that adjustment. So in addition to the $2,200 of income tax savings, the $200 of additional deductions from that senior credit, they get another $2,000 of savings on Medicare premium. So, you know, we're just under $5,000 of total savings based on a $10,000 charitable gift. So again, that qualified charitable distribution is one of the major planning strategies that we've seen for clients. Just a quick note, starting 2026, there is going to be a slight reduction in charitable deductions. It's an income-based thing. So in other words, 0.5% of your income is going to be used to reduce charitable deductions. I'm not going to get too much into that, but just be aware of, for people who are charitably inclined, you may want to think about, does it make sense to pre-fund some of your giving for next year, again, into December of this year to qualify before that new limit goes into place. A couple other new provisions. I'm going to go through these a little bit more quickly because I think you're probably most interested in some of the Social Security changes. There is a new deduction for people who purchased a new vehicle in the U.S. starting in 2025 through 2028. This means that if you're itemizing, you could potentially deduct some of the interest on an auto loan up to $10,000 per year. But again, this is means tested, so higher income taxpayers, so meaning more than $100,000 single or $200,000 for a married couple, that deduction would go away. Again, assuming many of you are already retired, so I'm not going to spend a lot of time here, but there were some new tax breaks for people who are earning tip income. You can potentially exclude up to $25,000 of that tip income under this new tax bill. Now, keep in mind, this is limited to occupations that customarily receive tips. So for those of you maybe in a business that doesn't customarily receive tips, you can't just add a tip line to your invoices. That won't necessarily be deductible. And then in addition to that, there's this new deduction for qualified overtime income. So that's up to $12,500 per person. And that starts in 2025. And again, that one goes through 2028. So to leave time for questions and so on, I'm going to kind of move on to the final major tax planning opportunity that we see for many of our clients, which is one thing that we see with a lot of our clients is that once you retire, that your income can vary over time. So for example, let's imagine a couple who has, total pensions between the two of them of $70,000 of income right now. But what we see with many of our clients is they might retire in their early 60s and they may not start their Social Security benefit until later. So imagine that they first couple of years they have $70,000 of income, and then their Social Security benefits begin in 2027. And then in addition to that, they'll have to start taking minimum distributions from their retirement accounts later on. So when we're looking at this chart over here, this green here, that would be their pensions. We put a little bit of investment income in there. The blue would be Social Security, and then the orange is their minimum distributions. So what I wanted to illustrate is that over time, this couple's income is going to be going up, especially when those minimum distributions starts. So currently, this particular case, that person's paying 12% marginal tax, but when those minimum distributions start, they're actually going to jump up into the 24% tax bracket. So one of the things that we often do with our clients is, in order to avoid that higher tax rate down the road, is we try to accelerate some of that future income. And what I mean by that is we basically try to take some of that future higher income and move it into the lower tax years. And we do that through a strategy called Roth conversion. So you're essentially choosing to prepay some of the tax on your retirement accounts by taking money out of your IRA and putting it into a Roth IRA or an equivalent type of vehicle. So the benefit there is you are choosing to prepay the tax, but you're hopefully paying it at a lower rate, maybe paying it at 12% now or even 22% now, but avoiding that 24% tax bracket down the road. So that's something we see a lot of. Again, it's complicated because you have to sort of consider your total tax picture, including your Medicare premiums and phase outs on certain deductions. But we do a lot of that for clients. So last thing I wanted to mention, so the big change this year was back in January, they passed what was called the Social Security Fairness Act. For many of you, we were probably subject to reductions in Social Security benefits because of participating in SERS. The idea behind that originally was that Social Security is also a means-tested program. And what I mean by that is, for people with lower income, they got a higher percentage of that income back in Social Security benefits. So occasionally there would be people who had a government pension, maybe they're making $100,000 a year as a professor or administrator, as well as earning $10,000 a year of supplemental income from, let's say a book or consulting income. So this Social Security provisions were put into place that prevented what they considered double dipping. And what happened in January was those provisions were reduced or revoked. So the windfall elimination provision and the government pension offset were taken away. If you were already drawing benefits, you should have seen a retroactive change where not only would your benefits go up starting after that change in January, but they went back and they paid additional benefits as if that provision revoked at the start of 2024. So just kind of a little bit of an overview of the two different changes that could happen. The first was the windfall elimination provision. And so this would affect people who were receiving a Social Security benefits under their own record and who also had a government pension that was earned while not participating in Social Security. And the impact of that was typically that your Social Security benefits were reduced by either 50% of whatever your Social Security benefit would have been, or $600, the lesser of those two numbers. So if you were subject to the windfall elimination provision, let's say it looked like Social Security statement was going to say you would get $1,500 a month in Social Security benefits, this windfall elimination provision would have reduced your benefit down to probably more like $800 or $900. You should have already seen your benefit adjustment happen for most of our clients. That happened in like February, March. And so you should have gotten both a lump sum refund for your 2024 benefits, plus in addition to that, you should have seen your benefits going up sometime starting in the spring. So this one is mostly automatic. Most people didn't need to do anything for that. In addition to that, there was another provision that was called the government pension offset. And what this one was is, for those of you who maybe didn't have a lot of Social Security earnings because you spent most of your career at a university, it prevented you from claiming spousal benefits. And spousal benefits were usually one of two things. So one spousal benefit would allow you to claim up to 50% of your spouse's Social Security benefit. And the other one would be that if your spouse died, you could generally claim your spouse's full Social Security benefit as your own. But because of the government pension offset, most people didn't get that because their benefit was reduced by 2/3 of their CSRS pension. So this provision was also repealed. So what it means is if your spouse is receiving a larger Social Security benefit, you might be eligible for either that spousal benefit, which again is half of your spouse's, or if your spouse has died, you might be eligible for up to 100% of your spouse's benefit. This one could be an automatic adjustment, but it only was automatic if you had previously applied for Social Security spousal benefits. And in our experience, about half of the clients did do that application, but they just didn't get any benefit because of it, of the previous government pension offset. The other half never even applied because they just didn't know that they would be eligible. So this one you do need to go to the Social Security office and apply for if you think you're eligible for it. And I'm going to not go through these instructions in detail. Presumably, Thomas, maybe we can get these slides out to people if you're interested, or maybe take a screenshot right now. These are our instructions of how to go apply for the Social Security benefits, either online or by scheduling an appointment with the Social Security office. So the last sort of planning point I'll make here, I realize we went a little long. I'll be happy to stay longer to do questions. Because of people getting the retroactive benefits, one thing that we've seen a lot of are people are going to have higher income this year. So two things to be aware of. One, higher income might mean a higher tax balance due. So just be thinking about that. But the other thing that we've seen a lot of going back to these Medicare premiums are for people who are right on the edge of bumping up into a higher Medicare bracket. This additional Social Security lump sum refund could push you over that threshold. So you might want to be thinking about, are there ways to reduce your income, such as qualified charitable distributions, in order to try to keep your income under those thresholds. So that was everything I had. Again, I'm going to open it up here for questions, and I'll just kind of mention if you want to get in touch with me, I threw my contact information up here, as well as we do have a monthly blog and newsletter that we write about topics that tend to affect our clients, which again, a lot of them tend to be CSRS retirees. So if you're interested in getting a free blog or newsletter, I included a link there for how to sign up for that. So with that, I'm going to pause and see what questions we've got.
Jacob, Richard Kaplan asks, at what income level does the enhanced standard deduction phase out completely?
A great question. Let me, I believe it is $100,000. So meaning, or let's see if I can get my PowerPoint to go back to a previous slide. So we said that the new enhanced senior deduction starts phasing out at $75,000 of income and $150,000 of joint. I believe it's $100,000 phase out, meaning that you completely lose out benefits at $175 and $250. I'm going to look that up real quick to double check. I think that's correct. But maybe we can go ahead and ask the next question while I verify. I've got to pull up a resource here to find that answer.
Mike had a question about the gift giving. Could you go over that again? He was asking, is it $19,000 gift per year, and is it only from one's retirement account?
So that would be this slide. So the $19,000 limit is to individuals. It does not apply to charitable giving. It also does not apply to education and medical expenses. So if you want to pay for your kid or grandkid to go to college, or if you're helping a friend or a relative pay a medical bill, those things are excluded from that $19,000 limit. Otherwise, that $19,000 limit is inclusive of all types of gifts. So it could be cash, it could be writing a check, it could be giving a family member an old vehicle. In theory, you should be keeping track of everything that you make gifts of to other individuals. So if you, for example, give your grandchild $15,000 towards the down payment of a house, plus you buy them flights to go on vacation with you, plus you give them a Christmas or a holiday gift, all of those things together are supposed to be less than $19,000. If you go over that limit, you are supposed to file what's called a Form 709 that just says, of my $15 million lifetime limit, I'm choosing to use some of that early by giving more than that $19,000 exclusion limit. It's a little complicated, but I hope that answer is helpful. Certainly throw it in the chat if there's a different part to that question that maybe I didn't address.
Wanda wants to know, for estate tax, what does quote unquote electing portability mean?
Yeah, so portability is essentially just meaning that the estate limit is $15 million federally. So what portability would allow you to do is it allows you to leave all of your assets to your spouse and allow your spouse to get credit for not only their $15 million limit, but your $15 million limit. So it effectively means that a married couple gets $30 million of total exemption from that estate tax. And Illinois does not do that. So the problem is for a couple who has basically what I would call an I love you will, where everything goes to the surviving spouse. And then after the surviving spouse dies, it all goes to the kids. There's no doubling up of that limit. So it's still $4 million.
And speaking of limits, for the IRA qualified charitable distribution, what is the taxpayer limit per year?
The qualified charitable distribution limit is $108,000 per taxpayer per year, meaning $108,000 if you're single, or if you're a joint couple, you can do $216,000 of qualified charitable distributions.
In regards to, I'm sorry, go ahead.
Oh, I was just trying to go to the slide with that information, but go ahead, Thomas, I can take the next question.
In regards to spousal benefits for Social Security, Nancy says, I am not taking my Social Security yet, waiting to maximize when I'm 70. So if my spouse will not be getting Social Security, they can apply for spousal benefit based on mine when I start taking mine?
That is a great question. I believe that. So let me back up. So if your spouse is not eligible for Social Security, they can claim a benefit under your record, assuming that you're married. The thing that I'm not 100% sure off the top of my head is I do believe you have to be claiming your own benefit for your spouse to claim that spousal benefit, but I'm not 100% sure about that particular nuance. I would have to look up the rules, or I would suggest making an appointment with the Social Security office, which can be difficult because of staffing issues. So again, we put some tips about here are the best times to get a hold of Social Security. Generally, we found that if you call kind of middle of the day, not on a Monday, that's the best time to get a hold of Social Security and request an appointment if you need one to sit down with a Social Security agent and go through your benefit options.
Jerry wanted to say thanks, Jacob. Super helpful. Joe Gibson asks, so we cannot use QCD from a 403B?
That is correct. Yes. The only type of retirement plan that is eligible for those qualified charitable distributions is an IRA. What you can do is if you have a 403B or another type of qualified retirement plan, is in general, you can roll over those retirement benefits into an IRA so that the next tax year you could take benefit of that qualified charitable distribution option.
Jerry asks, if you did apply long ago for the spouse benefit but got nothing per the GPO rule, does the repeal of that mean you should receive the benefit back to the beginning of 2024 or only to October of 2024?
It should be retroactive back to January of 2024, assuming that your application for those spousal benefits was submitted prior to 2024. So in other words, all the retroactive benefits were back to the start of 2024, but you would have had to have already applied for and just not been eligible for due to the previous reductions.
Leonard here had a comment going back to spousal benefits. He says, I just claimed my spousal benefit based on my wife's. Jacob is correct. The Social Security spouse must be taking their Social Security for you to claim your spousal benefit. Okay, I'm sorry, did you have something to add? It wasn't a question, just a comment.
Okay. No, I was going to say, thank you. Thanks for helping me out there. The rules are complicated and it's hard to keep them all off the top of my head. So I appreciate the support there.
Well, thank you, Leonard. Somebody asks, if I give a gift to relatives that is less than $19,000, do they have to pay tax on it as income?
No, they do not. So federally, there is no gift tax, meaning on the recipients of a gift do not pay tax on the value of that gift. The only exceptions might be there could be some states who have state inheritances or gift tax. So I guess check the rules in the state of the recipient. The other thing to know is if you give them property that has embedded gains, there could be tax consequences if they sell that property. So for example, if you owned a rental property that if you sold it, you would pay tax. And if you gave that rental property to a family member and they sold it, they would also have to pay that income tax that was embedded in that gift.
Wanted to just say that earlier, somebody, a woman, Penny, said, I thought after working at a university and paying into SERS for 20 plus years that Medicare B was supposed to be paid for. What have I misunderstood? Nancy Matthews responded that the SERS benefit is that trail. The Medicare Advantage plan is premium free. We still have to pay Medicare Part B. The University Professionals of Illinois retirees are doing a webinar on this next week. Jacob, can you convert a 403B to a Roth?
Generally, yes, you can. Whether or not your plan allows that is going to determine whether or not you can do it. So I know, for example, the University of Illinois 403B at both Fidelity and I believe TIA as well do allow in-plan conversions. Again, if there may be some other university plans with different provisions, if you're retired from the university, separated from service, if you want to do a Roth conversion, the other way to do it would be to roll that 403B into an IRA. And then from there, you could do a Roth conversion with a new plan, with a new IRA provider.
Larry Alfring, good to hear from you again. He asks, can I do a qualified charitable distribution beyond the RMD amount to reduce taxes further?
Yes, absolutely. So we have a couple clients that I was talking to this week about that exact situation. Their minimum distribution was maybe 30 to 40,000, but again, they've elected to give $100,000 to the university because are working to fund a scholarship, and they wanted to make sure that that money was in place as soon as possible so that the department could start spending that money right away. So absolutely, even if your minimum distribution is less than 100,000, if you have enough money in retirement accounts, you can go up to that $108,000 limit.
What if you are divorced for over 10 years? Would they, I'm assuming that means the ex-spouse, would they still need to be taking their Social Security before I can claim mine?
Again, the rules here are complicated. My understanding is if you were married for more than 10 years and then divorced, you are eligible for spousal benefits. I do believe that ex-spouse needs to be drawing benefits before you can claim that spousal benefit. One hiccup that we've seen is it is difficult to get Social Security to release information about an ex-spouse. So hopefully you have a good relationship with that ex where you can ask them for details of their benefits as well as their Social Security number in order to file that application for your own benefit.
In 2026, are qualified charitable distributions considered part of the 1/2, looks like 0.5%. And then it says AIG. I think it meant adjusted. I think it should have been AGI.
Yeah,
so in 2026, are QCDs considered part of the 0.5% AGI used for charitable deductions?
They are not. QCDs basically is just avoiding paying tax on income that would have otherwise been taxable to you. I guess I didn't put that on the slide, but no, there's no reduction of that benefit starting in 2026. So that's even another reason why we will probably continue to see more people doing those types of charitable gifts.
Mark says, I thought I had to donate more than 30,000 in a year to start to deduct donations. QCDs can be less than 30,000 per year? Is there a minimum limit for QCDs?
No. So QCDs really, it's not a deduction. What you're doing is you're choosing to avoid paying tax on income that's otherwise taxable to you. So each dollar that you give away is an avoidance of tax. So that's where the tax savings is coming from. And there's no minimum other than just the administrative effort that it takes in order to make sure that the money gets to the organization. So I guess theoretically you could do a $1 charitable gift from your IRA. It just might be a lot of paperwork for not a very big gift. But we do see all the time with clients, they're doing $250 or $500 gifts from their IRA to a few different organizations, for example.
Lori apologized and asked Jacob if you could restate the answer to the question on if you can convert a 403B to a Roth.
Yep, the simple answer is the IRS does allow it. The slightly more complex answer is as long as your provider also allows it is going to be the second limitation. So the general answer is yes, but you will need to check with your 403B provider because your former employer may not have added that provision in to their 403B plan.
Jacob, if our members have any further questions for you, should they go ahead and do you have a phone number they should call?
Yeah, it should be on this last slide here. Our office is telephone number 217-352-0000. Our website is bluestemfa.com. So that's Bluestem, F as in financial, A as in advisor.com.
And Jacob, your email then is jake@bluestemfa.com, as shown there on the slide. If you weren't, if you folks weren't looking at it. So, Mike says thank you both. Mike, thank you for being here. Thank you for all being here. We just so you know, Jacob, we had 180 people at the highest number, and we had 100 folks stay around for the entire Q&A. So I appreciate everybody staying here. Seeing more thank yous. Jacob, before we sign off, do you have any last words for our associate members?
Yeah, well, I appreciate the opportunity to be here. I hope this information was helpful. I think taxes tends to be one of those things that people don't think about until the spring. So I'm glad to see that people are being proactive, because as we talked about today, there are a lot of opportunities to think and make adjustments before the end of the year that might save you taxes before you start thinking about filing next February, March, or April. So with that, again, appreciate the invite to be here today, and keep in touch if there's anything that we can help you with down the road.
All right, and then Leonard says, I knew quite a bit before this and still learned a lot. Thanks. So again, thank you to everybody for joining us. Not sure when we're going to have our next webinar, but just know we will be continuing this series. Thank you again to Jacob. We really appreciated you joining us. And thank you again to all of our SUAA members for attending this webinar. And until then, have a fantastic day, a fantastic weekend, and we look forward to holding another webinar very soon. Take care, everyone.